What if I told you that one of the largest, most visible companies on the planet has a risk profile so low, it's actually safer than the debt of a sovereign government? It's a provocative question, and a powerful analysis makes exactly that case. This analysis presents a fascinating thesis titled, "Is Visa Overvalued? The Case for Structural Undervaluation." And what it argues is that despite its massive size, the market fundamentally misunderstands and, therefore, misprices the world's most dominant payment network. Now, to really grasp this argument, you first have to completely rethink what Visa actually sells. You see, their entire empire is built on a single, completely invisible product. Look, Visa doesn't lend you money. It doesn't hold your deposits. It takes on zero credit risk. Its core product is simply trust. That's it. The plastic card, the chip in your phone, the digital wallet, those are just the vehicles. And those vehicles change every decade. But the fundamental human need for trust between a stranger buying and a stranger selling, that is absolutely permanent. And here's a brilliant way to frame Visa's competitive advantage. It's not a sand moat, something built on regulations that can just get washed away by the next political tide. No, it's a coral moat. Think about it. It's built by its own usage. Every single transaction deposits another tiny layer of coral, making the entire structure stronger and more formidable. And the sheer scale of that usage is just mind-boggling. We're talking 4 billion cards in circulation, 130 million merchants accepting them, over $17 trillion in annual payment volume. Every new person with a card makes the network more valuable to merchants, and every new merchant makes the network more valuable to all of us. It's a perfectly self-reinforcing loop. Of course, no credible analysis can just ignore the threats. The bear case for Visa is very well known, and it absolutely deserves a serious look. So let's deconstruct the main headwinds that people always point to. The argument against Visa really just boils down to 3 major threats. You've got constant regulatory pressure, the rise of stablecoins, and the emergence of these big government-run payment systems. So first up, regulation. Yes, there's always pressure to lower interchange fees, but here's the thing people miss. Interchange is not Visa's revenue. Those fees go to the banks that issue the cards. Visa collects its own network assessment fees on every single transaction, no matter what the interchange rate is. In fact, when regulation lowers costs for merchants, transaction volume tends to go up, which can actually grow Visa's top line. Second, stablecoins. Now, their promise is incredibly compelling, right? Settle transactions on a blockchain for a tiny fraction of a cent and completely bypass the traditional card networks. On the surface, this looks like a direct existential threat. But this is where that argument really misses the forest for the trees. This quote just nails it. The rail is not the product. The product is the trust layer above the rail. Let that sink in. A stablecoin transaction gives you final settlement, sure, but it doesn't give you fraud protection. It doesn't handle chargebacks or dispute resolution. Visa provides that entire, incredibly complex infrastructure of trust that a simple settlement layer just cannot replicate. And this is the core of Visa's strategy. They aren't trying to fight stablecoins, they are absorbing them. Billions of dollars in stablecoin settlement already flow through VisaNet. So, you see, Visa is just positioning itself to be the essential trust provider for this new technology, exactly like it's done for every new technology that's come before it. And finally, you have the sovereign rails, like India's UPI or Brazil's Pix. And these systems are formidable, for sure, but they have a fatal structural weakness. They are domestic by definition. They can't handle cross-border commerce, and they don't offer credit. For global trade, for lending, the world still requires a global network. So, having systematically dismantled the threats, the analysis then pivots to the offensive case for Visa. And this is driven by a massive, truly unstoppable global trend. And that trend really begins with this one number, 85%. That is the percentage of transactions globally that are still done in cash. Think about that. Every single one of those cash transactions represents future growth for digital payments. The addressable market isn't just today's volume, it's nearly the entire global economy. And this leads to this really powerful concept called free growth. Visa doesn't have to pay to build the smartphones, or the e-commerce websites, or the terminals and stores that are driving digitalization. No, other companies and governments bear those costs. Visa just sits back and benefits as this massive wave of digitalization washes over the world, collecting its toll on a constantly expanding ocean of transactions. And the critical point to understand here is that this migration from physical cash to digital commerce is irreversible. The complexity of the payment system only ever increases. We are not going back to a simpler time. This is a one-way street, and every single step forward just adds more volume to Visa's network. So, all of this now leads us to the intellectual climax of the entire analysis, a fundamental structural flaw in how the market values a business like Visa. Which brings us to a real paradox. I mean, if Visa is one of the most visible, most well-understood businesses on Earth, how on earth could it be structurally undervalued? Well, the answer doesn't lie in the business itself, but in the financial models everyone uses to analyze it. Okay, so standard valuation models, they discount a company's future cash flows using a risk-free rate. Think of a government bond yield, and then they add something called a risk premium. That extra percentage, usually 3 to 5%, is there to compensate investors for the uncertainty, the risk that those future cash flows might not actually show up. Now, this is where it gets really interesting. What if the certainty of Visa's cash flows, which, let's be honest, just depend on humans continuing to buy and sell things in an increasingly digital world, is actually higher than the certainty of a government repaying its debt? Well, if Visa's risk is negative compared to a government bond, then the discount rate should actually be below the risk-free rate. And as you can see in this table, that one single adjustment completely changes the math. It dramatically increases the company's implied value, taking it from around $380 to over $640. And this gap, this space between the market price and the true structural value, is what the analysis calls the gratuity premium. It's the portion of value that is permanently missing from the market price because standard financial models simply cannot compute a negative risk. The spreadsheet literally breaks right where the truth about the business begins. So how do we put all of this together? Well, the conclusion contrasts the temporary, visible challenges with the permanent, invisible strengths of the business itself. And this is the final powerful summary of the whole thesis. The headwinds, the regulation, the stablecoins, the sovereign rails, they're real. They're visible, they're temporary, and they are fully priced into the stock. But the reef, that self-reinforcing coral network, the unstoppable wave of digitization and that negative risk profile is invisible, it is permanent, and for the investor who understands it, it is essentially free. A truly compelling argument. To explore these investment strategies further and discover more from the collection, visit the website averagingup.com.